Now we're going to talk about midterm rentals. This is a term that I hadn't really started hearing until just recently, but this type of rental has been in existence. They just didn't give it its own special name. So now we have LTRs, MTRs, and STRs because we love our acronyms. Midterm rentals are rentals that are more like long-term. They are Section 469 passive activities. We're going to define midterm rentals as an average period of customer use, typically 30 to 90 days. So more than a short-term rental, less than a long-term rental. Think like corporate housing, traveling professionals, travel nurses, people who are out of town for, a month or 2 or 3 at a time. They want a fully furnished, ready to live in place, but they don't want to stay in a hotel. So these are typically furnished. Because these are treated like long-term rentals, the hours for MTRs, for midterm rentals, count towards reps. So if you're trying to achieve real estate professional status, your midterm rentals and your long-term rentals both will help you qualify. They're treated just like long-term rentals for passive versus non-passive decisions. And again, just remember, passive losses are limited to passive income, which is why so many people are trying to go for short-term rentals in their tax planning strategies. Now, we already talked about 3 ways to avoid passive activity loss limitations. Those rules are the same, so this slide should look very familiar. The 3 ways to avoid passive loss rules are an entire disposition, meaning you sell the property. In this case, we're going to say rental properties, but these rules apply to any passive investment. So you sell the rental property. If you earn less than $150,000, and that's going to be combined total on a married filing joint return, you actively participate and you own at least 10% of the activity, you can qualify for a loss allowance of up to $25,000. So if your income is under $100,000, you get the full 25. Then it phases out $1 for every $2 of income over $100,000. And then the third way, of course, is real estate professional status or the short-term rental loophole. We've seen this slide before. So the way to get out of passive activity loss limitations does not change based on the type of passive activity. What is a little bit different is qualifying like for midterm and long-term rental losses to not be passive. They're not short-term, so they don't qualify for the short-term rental loophole. If you're over that $150,000 in income, the only option left is real estate professional status. It's harder to qualify for that than it is to qualify for material participation on a short-term rental, which again is why that short-term rental strategy is so powerful. So the first rule for reps is the 750-hour rule. That means you spend, let me fix my typo. You spend at least, oh geez, why didn't you guys proofread this for me before I showed up? Okay. You spend at least 750 hours on real property trades or business during the year. What is real property trades or business? Development, construction, acquisition, conversion, rental properties, management, leasing. You own a real estate brokerage. The thing that all of those have in common is that it's actual work you do, not investment activities. You are actually doing the construction. You are actually actively managing the rental property. You are managing the leases. You are actually doing real estate work. What is not included in real property trades or business, and this trips a lot of people up, education. So time spent educating yourself about real estate investing rules does not count. The time you spend searching for properties does not count. Studying your financial statements, although super important, and I highly recommend you spend a lot of time on it, is not going to count towards your rep status. Managing the finances of an activity in a non-managerial capacity, I'm not even exactly sure what that means, I'll be honest, but you can't do it. Preparing summaries of finances or operations, that means running the financial reports. Commuting, that doesn't count. I love this one. Work done primarily for the purpose of avoiding the disallowance loss. So if you're just doing stuff because you're trying to make it count, it's not going to count. The other thing that trips a lot of people up is being an employee of a real estate business does not count. So if you work for a real estate broker as, say, you're a W-2 employee in the leasing office, unless you own at least 5% of that business, your time as an employee does not count. We see this a lot. I feel like this came up before with like mortgage loan originators. You are a W-2 employee, so it's not considered real estate. So that doesn't count towards your rep status. Any questions about reps before I move on to the next one? Cool, you guys are gonna be super easy today. And Tosin, I see your question in the chat and I'll come back to that. All right, the second rule is greater than half of your professional time rule. So you have the 750-hour rule, and this is not one of those you have to meet one, this is you have to meet all. You have to spend at least 750 hours, and that has to be more than the time you spend on any other activity. So if you do 750 hours of real estate management and 1,000 hours of tax returns a year, sorry, brah, you're not a real estate professional. And that trips a lot of people up. It's a little confusing since it's not all the tests like some of the other areas. And so got to do 750 hours and more than half your time. So generally, if you have a full-time W-2 job, you're not going to meet rep status. On a side note though, for the 750-hour rule, your spouse cannot help you qualify. You can't combine the time of the two taxpayers, but for the greater than half the professional time rule, you can. So if you have like a high earning W-2 spouse, and then the other spouse qualifies for reps, they get to take advantage of reps on the whole tax return. So that can be kind of powerful too. Let's say you have a super successful accounting firm owner, and then her husband is in real estate. We might be able to take advantage of rep status and then offset some of my amazing accounting firm earnings. And of course, my dog only barks when I'm on meeting. We'll just close that door. Okay, any questions about the greater than half of your professional time rule?
I have a question. What about people that do construction work or electricity and they own rentals? Does that count too?
So it can for material participation, as long as they're not employees of a construction company or an electrical company. They have to be the owner.
Okay.
Yeah. And then the last one is material participation, and this should look very familiar. There are 7 tests. There are 3 main tests, but you only have to meet one. You participated in the activity for more than 500 hours. Does this sound familiar? Your participation was substantially all of the participation, including for non-owners. You participated for more than 100 hours during the year and more than non-owners. So this test is the same test we talked about back on slide 8 for short-term rental material participation. I forgot what slide we were on. There we go. Okay. That was like quick and dirty, but midterm rentals, like I said, just aren't as fun for tax planning. But I wanted to talk about them because you're going to hear that term more and more. Some people find it attractive because they like the transient nature of short-term rentals, but maybe they just, I don't know, they don't want to deal with like, or maybe they live in an area where they don't allow short-term rentals. So that goes to Tosin's question in the chat. He wonders if midterm rentals work in cities like Dallas outlawing short-term rentals. Looks like a good workaround. It can be. So you'll still have to look at the city's rules. They may have rules that give a specific answer, but generally, like I live in an area, Virginia Beach, Virginia is a touristy area, and they were outlawing short-term rentals. Now they've started opening up the licenses for that, but they only have a certain number. And so if you can't get one of those licenses, then you can't run a short-term rental. So a midterm rental could be a good workaround if you don't want to deal with year-long tenants, but you can't have a short-term rental. Now, again, it's not going to unlock the same tax savings that a short-term rental will. So you just have to decide Is it easier to manage a long-term rental where you're only going to have one tenant a year probably? Or do you want to do midterm rentals where every 30 days you could be turning over? I think that's a personal choice. There's really no tax difference between the two. So it really comes down to what kind of rental property you want to have. So that was like 20 quick and dirty minutes recapping both short-term rentals and my whopping 3 slides about midterm rentals. Any questions about that?